You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey of the Wealth Formula Podcast. First of all, reminding you that there is all sorts of resources for you at wealthformula.com, including the ability to sign up for our Wealth Formula Accredited Investor Club. So what does it mean to be an accredited investor anyway? An accredited investor is not something that you sign up for, or you train for, or anything else. It's either you are one or you're not, sort of like being pregnant. And what that means is, in the case of the accredited investor, if you make $200,000 a year, $300,000 if filing jointly, or you have a net worth of $1 million outside of your personal residence, then you are an accredited investor, and you should sign up for the Investor Club on wealthformula.com. Now, also, there's an opportunity to get a free book there. There's my book, The 7 Secrets of Eternal Wealth. That was #1 seller on Amazon. You can also just text 44222 and get a free copy of that if you text 44222 and type in Wealth Formula, one word. Now, one thing I do want to say is that last week we had this podcast with Tika Tiwari, and I wanted to promote his newsletter because I'm a big fan of his newsletter. And the newsletter is, it's about digital cryptocurrency, and I have been a subscriber since 2017, and it is really good. It's high-quality stuff, really good information. It's not the only source I use for cryptocurrency and digital currency, but it is one of the ones that I think really gives you a significant sort of great overview, and the majority of the assets that Tika recommends, I think are high quality. And I think his idea of asymmetric risk and, allocations, very small allocations into these, a couple $100, whatever, and seeing what pops is a really good idea for some people. The problem was that there was some, the Palm Beach Confidential copy, the sales stuff that goes along with it is a little bit over the top. And I talked to Tika about this, and Tika says, yeah, my own friends make fun of me. It's not like he writes this stuff, guys. We've talked about this before. Newsletters, like anything else, are things that, people try to sell, right? That's how they make a living. Doesn't mean that they're good or they're bad. Sales letters, have to be sold, right? These newsletters have to be sold. And basically, the copy that was sent out in, by Palm Beach Confidential, which I forwarded, which I also put on disclaimers about, saying, hey guys, don't read, the copy is really cheesy. This is a 2 or 3, I've been part of this newsletter for 2 or 3 years. It's high quality. Even despite that, I send it and I get people telling me, oh, this is terrible, blah, blah, blah. And I just got to say, guys, come on, lighten up. All right. Here's the thing. There's multiple assets that I have invested in that were in Palm Beach Confidential that resulted in significant gains, like serious gains, right? Now, unfortunately for me, I chose not to sell. Had I sold when I should have, I would have made a lot of money off of those investments. But I didn't. But the bottom line is I was given direction on things that worked. And all I'm doing when I, pass on this information is giving you an opportunity to do something that I did too. But I think the moral of the story is, though, that you can't, some of the emails I get are about how it's so salesy. And the same people I know who are sending me those are buying into other things that are incredibly salesy too. So it's like pick your poison. I don't care what the sales message is. What I'm really interested in is knowing what the underlying information or the underlying asset is itself. And that's why I felt like it was okay to promote Tika. And that's my story. So I'll probably do it again, but next time I promote Tika's newsletter, I'll just write an email myself telling you about my experience rather than sending his copy. Now let's talk a little bit about today's topic, okay, which is, the economy, multifamily real estate. There's clearly a lot of fear in the heart of investors in the equity markets and real estate alike. You hear these talk, whether it's on the news or whatever, and social media, et cetera, about trade wars and recessions. They're everywhere, right? The problem is that, you got some of these guys who've been saying the same thing for 4 years now. But meanwhile, for me, I'm investing more in multifamily real estate than I ever have right now. This year alone, I was probably my biggest year. It is my biggest year investing in multifamily real estate. And in fact, I am investing my 80-year-old father's money in the same offerings, right? So that's how confident I feel. I mean, literally. I mean, I could invest my own money and lose my own money, but I'm investing my dad's money in the same deals, and they're the same deals that people are seeing in our accredited investor club. So if you're wondering what it is, so why am I investing so much right now? Well, lots of reasons, and here are just a few, right? So number one, I can't time the market. There's a podcast echo chamber that I've talked about before, where it's like everybody says the same thing, and you hear it so many times you start thinking it's true, right? There's this podcast echo chamber that's been going on for at least 4 years now, telling you that you got to be afraid, that you got to be buying gold, and that hasn't worked out that great for people over 4 years. And since then, I've been out of over the course of those 4 years, I've been in and out of multiple deals, and I've created, a fair amount of wealth during that period. And if we do have a recession in the next year, which I don't doubt, the question is, well, so what? Does it have to be a bloodbath? I mean, 10 years ago, it was a bloodbath in 2008, but that was a once-in-a-lifetime thing, right? I mean, most of the time, recessions are things that happen. You hear about it on the news. Oh, yeah, there was a recession. We were in a recession about, 3 months ago. We were in a recession, and it started about, 6 months ago, and it lasted for 4 months. I mean, that's the way recessions used to be. The other thing is the average length between recessions is about 5.5 years. So if you enter an investment today, by the time you're ready to sell and complete that sort of, exit for your investment, you may be back in the entire, in the same part of the cycle again, up high in the cycle, right? So you could have gone through an entire cycle of recession and then recovery, and then you could be back in a time when asset prices are, people are saying they're elevated again. You just can't predict it. So what's the point? So that's number one. I can't time the market. Number two, I only invest in quality assets that are in quality markets. Okay. So what does that mean? Well, I like multifamily real estate located in high growth areas. Now, if there's a strong population growth and jobs that are happening organically today, then in my view, there's no reason that demographic trend in particular shouldn't continue with or without a recession over the next few years, right? So you've got a market like Dallas, for example, and it's, kicking butt, or Houston, or some of these other markets that are just killing it. Okay, there's a recession. Maybe there's a slowdown. All right, but what happens in 3-4 years? Those same markets are killing it again, right? Even if there's a recession tomorrow. So bottom line is, what can you do? You can't time it. You got to keep investing, right? Invest in those really good, high-quality markets where, there's true organic growth. Don't go to those tertiary markets where people are only there because they're chasing yield, right? Nothing against Oklahoma City, but it's a classic example. People going over there because they think they're going to, get a little bit better cap rates. But the reality is any growth that there is in that, any cap rate compression that you're seeing there is really, it's not organic at all, right? All it is people chasing yield. There's not something inherently happening like there is in Dallas and in Houston, where these markets are truly transforming, right? So you have to just stick to quality markets, quality assets. And if I do that, I don't worry too much about, losing money, right? I don't worry about losing money. I don't think I will, even if there's a recession. Chances are I'm going to continue making money. All right. So number three, the third reason why I'm still investing a lot into real estate. Well, this goes back. Let's follow up on the question of what makes me so confident that I'm not going to lose money. Well, the basic thesis of my investing is to not buy and hope. Buy and hope is not for me. That's not what we want to do. And for those people in Investor Club, that I'm a believer in this idea of forced equity, of driving value into properties, driving net operating income. Those are the strategies that I'm interested in. I'm not interested in buying and hoping. That means that when we drive up net operating income, we're dynamically decompressing our own property cap rates, and then that gives us a bigger cushion in the event of any slowdown. So just as an example, we work with a group in particular in Investor Club, and that group, our average returns over the last 6 years have averaged 30% annually, right? So this has been in a market that has trajected up, but that 30% is not just because the market went up, it's also because of a massive amount of value add. So you're way above pro formas in these properties, okay? But what that tells me, the 30% annualized returns is we're doing something right, and we have a lot of cushion before we would even worry in the least about losing money. So that's what I would tell you there. Number 4, I believe in the volume averaging approach. Okay, now this goes back to the fact that I cannot predict market cycles. I don't like missing bull markets. And in reality, that I would rather have potentially less growth and capital preservation in the case of a recession or some sort of pullback. I'd rather have that than negative growth, which you would get potentially by keeping your money in the bank or in the stock market. So again, to me, multifamily real estate in particular is a recession resilient type of thing in the right hands is the place for me to be. As long as I invest in the right deals with the right operators, I just keep deploying capital, right? That's what I got to keep doing. I got to deploy capital. And eventually that's just going to average out. I'm going to come out where I think I'm going to come out. Now, finally, the fifth reason I'm investing in so much multifamily right now, frankly, is that, I'm literally betting my life, my financial life, on the group of people that I'm investing with right now because I believe in them so much, and that's one of the reasons I'm deploying more capital than I ever have. The longer I'm in this investing game, the more I'm convinced it has more to do with the team than the asset itself, right? It's really about execution. It's really about, taking an asset. You could have the same asset in 2 completely different set of hands. One of them is going to come out making you 30% annualized returns, and one of them is going to maybe even lose you money. Who knows? The bottom line is it matters, and it matters a tremendous amount. And the fact that I'm putting so much money into these properties, and again, these are all Investor Club things. So, if you're wondering where I'm deploying all this capital, you have to be an accredited investor. But Investor Club, those deals that people are in that's where I'm putting money. So I'm putting so much money. Am I worried about it? No, I'm not. I don't think there is anything near 2008 coming up in the next couple years. But even if it were, I feel like I'm in a very safe position with an extremely competent team, and I think I'll be in as good a shape as anyone else. So that's my story, right? Now, do I sound too optimistic? I would say that, frankly, I'm being realistic because I am factoring in the possibility and probably the likelihood, in my view, just from hearing what I'm hearing, of a downturn. But understand that, even though I believe that it's likely that there will be some kind of downturn in the next year or 2 years or whatever, I believe in the long term, specifically in the next decade, that I think it's going to be a tremendous economy. I believe the next decade will be the roaring 20s, just like guys from ITR Economics called it on my podcast not too long ago. If you're curious about that one, look for the one that says the roaring 20s and the depression of the 30s, which I thought was absolutely fascinating. But I am completely on board with that plan. I think the 20s are going to rocket. And why in the world would I sit here and try to time out a speed bump, something that I think that we're well prepared for the way we're investing right now? I mean, I don't want to miss any of that roaring 20s. I don't want to miss any of that. Anyway, that said, I'm always listening to what other economists have to say, what other smart people have to say. In fact, on this week's Wealth Formula podcast, I have a highly respected economist who specializes in multifamily real estate. His name is Ryan Davis, and he definitely knows what he's talking about. So make sure to tune in after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is an economist by the name of Ryan Davis. Ryan is Director of Research and Client Services at Witten Advisors. Before that, Ryan was Vice President of Royal Bank of Canada's Capital Markets Division, where he was responsible for originating, underwriting, and closing multifamily and commercial mortgages for inclusion in CMB pools and for the sale to Fannie and Freddie. In other words, he is an economist who really understands real estate, which is exactly the type of economist that makes sense for us to talk to. Ryan, welcome to Wealth Formula Podcast.
Well, thank you for having me. Glad to be here.
Yeah, and so first of all, I just want to say Ryan's going to be joining us at the Wealth Formula event September 27th to 28th. I think we're probably, I'm pretty sure we're sold out, but you can go to wealthformulaevents.com and check that out. Ryan, Let's talk a little bit about you and what Witten Advisors what it does, just to get some perspective in terms of what your perspective is.
Yeah, absolutely. So just a little bit of background on about me and why I'm an economist now is that I rode the wave of the real estate boom in the early to mid 2000s, and then was at RBC Capital Markets, and remember when the securitization markets froze up. I remember our satellite offices, being let go throughout the year. And then one day I came into work and sat down on my computer, and then the black screen it just went dark, and they pulled me in and said, we're going to have to, let you go. And so kind of part of the reason why I became an economist is to try and understand that bigger picture. So, what I experienced during that time frame, doesn't ever happen again on that widespread basis. And so I went back to grad school and then linked up with Witten Advisors almost 7 years ago now. And what we do is we focus on multifamily fundamentals, and what more importantly, the drivers of apartment markets in the major markets across the country. So from the West Coast to Northeast to Southeast, Texas, et cetera. And how we add value is we approach it from a top-down approach. So how is the economy and demographic trends, how is that playing out across local markets? And kind of just a little bit of background on our firm. Ron Witten has been in the apartment research business for 40 plus years, right? And he was a pioneer in data for multifamily. And so back when, it was amazing to have rent growth for Dallas. He was one of the first ones to do that. And so, he built up MPF research and sold it to RealPage back in 2000 plus range. And then he took some time off and pulled CEOs and executives of apartment companies around the country and said, how could I add value? And one of the options was be a nitty gritty data research provider. Another one is kind of the feasibility study. And the third option was to be more of an advisor and not so much a dot producer, but a dot connector. And so what we try and do is make sense of all the economic data and what that means for apartments going forward. And kind of the overwhelming response from that survey was, do not give us any more data. I mean, that was back in 2002 from executives. And so that's how the Witten Advisors has started. And so our clients are nationwide developers, private equity groups, local value add players, some debt companies as well. So a wide spectrum.
Got it. So, understanding your perspective on that, and again, it's in terms of what we do as my investor group does, and we're heavily into multifamily. This is really helpful. A lot of people are worried right now because a lot of the things you hear in the press and the oncoming recession, if that's going to happen. First of all, I guess the question for me is what's your guys' perspective from as an economist? I mean, do you agree that this happens in the next few months? And if it does, what does that look like broadly for most high-paid professionals? And the reason I asked that question is I think that what's tricky is this has been one of the longest expansions. I think it is the longest expansion in U.S. history. It's 10 years. And for a number of us, even in our 40s, I mean, we don't know much in our adult, financial lives outside of the downsides of what happened in 2008, but a recession doesn't necessarily mean zombie apocalypse, right? So I'm trying to put this in perspective. Do you guys think there's a recession? If there's a recession, what does it look like? Is it something that you hear about? There's something that goes off in the hills, in the industrial and manufacturing sectors. Can you give us some color on that?
Sure. I mean, one thing is obvious that we're living in a recession obsession world right now.
Right.
I mean, all the headlines are just focused on yield curve inversion. Our quick takeaway is that we do not expect a downturn. It's a slowdown for sure, but no, imminent recession lurking around that corner. And, our favorite metrics to look at are the 2 and 10-year Treasury spreads. And that inverted for several days, but it's now back to the positive. But more importantly, it's looking at that taking out the short-term gyrations, looking at the monthly averages of the spread between those two bonds, and that has a very powerful record of leading recessions, and we're not near that right now. And so even if that spread inverted for a full month beginning, let's say it just happens to be this month, then it generally takes about on average 16 to 18 months for a recession to come around. And so still, even if that spectrum does invert, then we still got some time. Then in addition, there's the argument that this time really is different. I mean, you're always a little bit nervous making that statement, but still, 10-year treasuries, there's a very good argument that after quantitative easing, then also negative bond yields across the globe, that there's a demand for U.S. 10-year treasuries, which is weighing down. At the same time, the deficits being financed by short-term debt, which is pushing up short-term rates. And so there's an argument that maybe this time really is different. On top of that, back in 2008, the Federal Reserve changed how they do monetary policy, and so we have over $1 trillion in excess reserves in the banking system right now. And so even if there were to be a recession, the capital markets are very healthy, and so it would look to us like it'd be more like an early 90s, more of a rolling recession where it'd be some layoffs, but not as deep, not what we experienced during the tech, right? Not the housing bust or great financial crisis. And so it would be a pretty quick V-shaped recovery. That said, I mean, we don't expect that, but job growth is slowing. The economy is slowing, and it's not due to anything fundamentally wrong with the economy. It's just due to demographics. And
Sure.
we don't have this big pool of unemployed people out there. And then further, the baby boomers are retiring. They're just being replaced by young adults entering the workforce. And so for the first time during an economic cycle, we don't have this big wave of young people that are being able to generate the big job growth gains, et cetera. And so just those sheer factors are going to limit our growth rate going forward.
Right. So so say there is, some sort of recessionary activity. If it's isolated to, I've heard, another group that I that I follow is ITR Economics. They've predicted probably, slowdown and likely recession, but in very specific areas like the industrial manufacturing part of the market. And if that does happen, it may be a silly question, but does it have to result in a massive stock market correction? And does a stock market correction necessitate a residential real estate correction? Do you see what I'm saying? Like, to me, it's like, that's what I'm trying to figure out is, okay, to me, what I'm hearing from economists who even think that there is a recession imminent is that it's not all sectors. It's specific to some very, manufacturing industrial sectors.
Yeah, no, I mean, we've already experienced, the oil and gas, downturn when oil prices cratered, and there was a big, concern that, companies were over levered and that was going to spill over in the bond markets, and it had this cascading effect, to capital markets and the economy. No, we, weathered that storm. And so I think that, balance sheets and the banking system in just a much better place. And so they're we can weather any downturn in the industrial manufacturing sectors, or any slowdown exacerbated by trade policy in certain
Right.
retail sectors, et cetera. And so I think we're in a very healthy position. And so no, I would not think that would it must lead to the correction in the stock market at all.
Yeah, right. Now, we often hear about the housing market, right? The housing market. However, when you think about what that is, it's like single family houses, it's apartment buildings, it's the development space. When things happen, do these markets tend to correlate with one another? Because to me, it's also, when I look at, and I'm here over in Santa Barbara, when people are buying $6-7 million single family homes, and that's not even the expensive ones. How is that correlated to working class apartment buildings in, say, Dallas, or what's the correlation there?
Yeah, I mean, they are somewhat correlated, because, if there are fewer jobs, there are fewer paychecks for people to, pay rent or pay the mortgage. And so in that case, if there's some kind of evaporation of housing, demand in general, then they are correlated. But, as we've seen this cycle, the single family construction, apartment construction have gone the opposite way, where multifamily was really quick to ramp up, where single family has lagged for all throughout this cycle. We're just now getting back to levels that are relatively normal. And then just looking at the demographics of single family and apartment renters is that they're completely different. And I'll go further than that, just looking at single family, so you can break that into owners and single family rentals, which is single family rentals. That's the hot topic of du jour. And those demographics are much more aligned. And so any increase in the homeownership rate, that's really due to people going from single family rentals to single family home ownership. Now there are some apartment folks that are aging and getting married and moving out and buying homes, but that's been relatively subdued, just to people getting married later, having kids later, et cetera. And so there is some correlation, just because kind of all industries are tied to the overall economy, but there are some very drastic differences. And then also to that point, going back to the recession question, is that by our estimates, we have 1 million fewer housing units just overall than we would normally have at this point in the cycle. And so we haven't overbuilt. We aren't over our skis as we were in prior recessions in terms of housing. And so that would, kind of indicate that real estate might, especially residential real estate, might outperform during a downturn.
Yeah, I guess that goes to my approach. My personal approach is to invest right now. I focus on good value add assets, maybe not development's really not my thing, but specifically in high growth markets. I like multifamily real estate because of exactly what you said. Then, people got to live somewhere, right? And so what you're telling me is the numbers actually back up that, that instinctual sense of that's where there's some security.
Yeah, that's right. I mean, you can't sleep online, right? Now, in the apartment space, there are some pockets of weakness where certain submarkets where all the equity is wanting to be, this live work play environment. And we've seen, 4 projects go up on the, same intersection. And so those are all competing against each other. But then, as you get out into, the suburbs and older properties, they're much more, NIMBYism out there that fight new development. And so those have been relatively insulated from the wave of supply that is hitting many areas of certain markets.
Right. So, I mean, for me personally, that would be also, stay away from potentially like tertiary markets, because it seems like there is this desire among investors, maybe not the smart money, but certainly I think amateur syndicators, things like that, to go into markets like, say, in Oklahoma City or something like that, where there may not be true organic growth, but, people are chasing yield. I'm curious what your take on this is, because my inclination is, okay, I'd still pay a little bit more just to stay in a market like Dallas, Fort Worth, or Houston, where it's got organic growth, got a lot of business activity, massive net population, Is that kind of like what you would say is perhaps a safer approach?
Yeah, I would tend to agree with that. And in part, it depends on your time horizon as an investor and just in your overall investment strategy. But kind of, looking at Oklahoma City, you may be able to get higher going in yield there, but you may, that may degrade, over time. But then more importantly, on the exit, is the capital going to be there to, so you can sell that investment. It's there. It's going to be there in the major markets, even in a potential downturn. And so, I would generally agree with that. In terms of some of the high growth markets, those are also the ones that are seeing the highest growth in supply. And so you think of the Austins and Charlottes and Raleigh, phenomenal demand stories, right? The economies are humming, young adults want to move there, et cetera. That's also attracting a lot of capital. And so in terms of investment horizon, there may be some period of 1 to 2 years where you have to fight through some weakness in pricing power, but then over the long term, those should outperform.
What are some of your favorite markets? You just mentioned a few there. There are markets that people kind of know about, but if you say, okay, you talk about Dallas, say like 10, 15 years ago, maybe 15 years ago, and people wouldn't have really thought of Dallas as being like a huge growth market. Now it is. What potential markets do you see out there that maybe people aren't looking at when you look at the numbers?
Yeah, no, it's interesting. Dallas, used to be viewed as a tertiary market. Right. Beginning of the cycle, right? Now everyone wants in. But yeah, in terms of overall health, we love Fort Worth, the western side of the DFW metroplex. Dallas should remain strong, but it's going to just kind of average rate of performance. And then Austin, we think that Austin should underperform over the next 3 years. And the story is completely due to supply. Austin was one of the first markets to really get cranked up, and the number of units being built there, 8, 10, now 12,000 units on a yearly basis. And just looking at how much the apartment stock in Austin has expanded. It's expanded by about a third since the start of this cycle. And then by the end of 2022, it should expand by almost over 50% or so. Wow. This leads all of our markets. And so, again, there's just so much new product coming online. And that would mean a third of all the apartment units in Austin have been built in the last 15 years at the end of 2022. Yeah. And so, there's some nuances across markets. Houston had a pop after Harvey, and deliveries slowed to a crawl, but they were really fast to ramp up. If I showed you the starts graph on Austin or Houston, you would be just shocked at how quickly developers ramped up and stuck shovels in the ground. Then looking at the Southeast, we like Atlanta, Charlotte, and a little bit of the Austin story with kind of more supply pressure. Raleigh's a little bit higher just because less supply. Nashville, we think we're past peak supply. There's capital flocked there. 3-4 years ago, we saw a bunch of new projects coming online. They've all gotten absorbed for sure. The demand is there, and that's the story across all markets right now. Is that the demand is there for apartments. Now you might have to suffer in terms of rent growth for a little bit, but the demand is there. And so Atlanta, we like Atlanta, and then the markets in Florida as well. But then also looking in the inner west, we love Vegas, we love Riverside, we love Phoenix, and that just speaks to the affordability migration coming from coastal California. You spoke to that affordability issue, that the migration numbers. The number of people that are moving into the Inland Empire, Las Vegas and Phoenix from California, it's staggering. And those three markets are Vegas and Phoenix are the leaders in terms of rent growth, ramping up to 8% in both of those markets on a market-wide basis. That's nutso. And so, yeah.
So I'm curious about Vegas in particular there. That's not one that necessarily has been on my radar. Certainly Phoenix has. Vegas, is that demographic that's moving in there different than what it was, because obviously in 2008 it got destroyed, right? It got absolutely demolished. So did Phoenix, but Vegas was, it was on the news. People going on bus rides through through Vegas, and buying houses for pennies on the dollar. Is that a different demographic? I mean, certainly in Phoenix, it is a completely different market than 10 years later. But I don't. Can you talk about that real quick?
Yeah, I mean, it's changed, somewhat. I mean, still, it's going to be a gaming, tourism, focused economy. But yeah, it's changed, more attractive to young people. But then, in addition to the strong demand and people wanting to move there, just magnets for migration, is that supply. I mean, like you said, it just got crushed along with Phoenix and along with the Inland Empire. And so investors are gun shy right now. And so that has led to just low levels of construction in all three of those markets. Well, Phoenix, not so much anymore. In the past 2 years, it's finally, began to catch up. But in Vegas and Riverside, just the amount of new projects being built are just minimal. And so that's that's leading to increased rent growth in those markets.
So, let's just kind of do a little, let's talk about, just broadly speaking, next decade. I'm just going to ask you to be, economist prophet here. Why, I mean, I presume that you probably have a bias towards multifamily real estate to be there. What do you think over the next decade? Is it really the place to be because of demographics? Do you think there's other kinds of real estate that you like that might be better or worse, or just give us some color on that and from what your perspective is in the next decade?
Sure, yeah. And so I'll preface it with that as an internal company policy, we do not invest in any real estate, any developments. We have lots of public REIT clients. And so there's always fear of insider information. And so we don't invest. And so we just want to be third party.
Just information.
Yeah, exactly. Yep. All right. So with that said, going forward, we are bullish on multifamily for several factors. I think in the near term, if your investment thesis is we expect a downturn, then multifamily is recession resilient. It's outperformed other property types in the prior downturns. And then in addition, where multifamily really shines is in the early stages of the recovery, with the short-term leases able to recover very quickly. And so just in that kind of recession scenario, multifamily outperforms. Going forward, kind of the longer term, just in terms of the demographic drivers, and we look at what we term the propensity to rent apartments. And basically that's the share of households that are choosing to live in 5+ rentals. And if you look back, that share has been increasing for 4 decades. And there's some ups and downs with the housing boom and bust, et cetera, the baby boomers becoming young adults, et cetera. But that share has been rising, and we do not think it will ebb or be flatline even. We think it's still going to increase going forward, and that just speaks to lifestyle changes of people staying single for longer periods of time, waiting longer to have kids, et cetera. That just pushes people into rentals for longer, and many of which choose apartments. And just in terms of the economy, we expect continued growth. Now it's not going to be the 3-4% range that we've been accustomed to in prior cycles. It's going to be limited by labor force growth, which may be closer to 0.5%, 1% going forward. So we're going to slow down, but still, if you break job growth out into from that aggregate number into the ages, that baby boomer cohort is retiring in droves and being replaced by a big 20 to 30, 40-year-old crowd. Well, we're past peak millennial, but still there's good growth in that age group, and so that's just weighing down on the aggregate numbers. And so if you look in, kind of break that apart, it's still very good for apartments. And then in addition, that people are living in apartments for longer, and so you have that peak millennial group that is getting into their early 30s, but they're going to stay in apartments for longer. And so we just think that all of these trends are long-term in nature and are not apt to change, absent some change in federal policy where it increases home ownership or anything like that. But still, we think that going forward the demand is there, and then as long as supply remains contained, which right now we've been about 350,000 units on a national basis for the last 3 years or so. And so we don't see that trending higher and higher, just with where land costs are, construction costs, labor, and now, tariffs on materials, et cetera. That's all just weighing on the economics of a profitable development deal. And so we think supply will be relatively contained.
Fantastic. So Ryan, you are going to join us, as I said, at the end of this month in September in Dallas, and give us a great look at what you're seeing around you. A nice presentation. We're excited to have that. How else can we learn about what you guys are up to in the meantime?
Sure. Yeah. I mean, you can look at our website. We have a little blog called the Witten Advisory that we post an excerpt from what we provide to our clients on an ongoing basis. Just once a month. Hey, here's a chart, and here's some narrative and context around it. So that's one way. We do a lot of speaking engagements. So I don't know if you lots of in Dallas, but also across the country. So you can look us up if we're speaking at an event. So that's one way. And then also just reaching out. Go to our website. Our email and contact information is there. So happy to answer any questions you have, or just have conversations about markets.
Ryan, thanks again for being on Wealth Formula Podcast.
You're welcome. Thank you for having me.
We'll be right back. Welcome back to the show, everyone. Hope you enjoyed that conversation. And if you are a heavy multifamily investor like I am, it probably should give you a little bit of sense that you're on the right track. I think that it's pretty much in line with kind of what I've been saying all along. I mean, listen, at the end of the day, if there's a little setback, I think what we have to be thinking about is, okay, capital preservation. All right, let's just hunker down and our capital's in a safe place and safe hands. And when the economy turns, we'll make money. That's kind of the way I'm approaching it. So, that's kind of what my philosophy is. Now, let me just, before we wrap it up, just want to remind you of one thing, which is that we do have this meetup coming up. It's Wealth 2.0, Dallas, Texas, and Ryan will actually be one of the speakers there. He's going to do a really interesting conversation. He's going to have a really interesting talk about the economy and multifamily real estate, which you're not going to want to miss, along with Tom Wheelwright, Dave Steele, Doug Ludmell, a bunch of really smart people. And then we're going to do a multifamily trip around Dallas and look at a bunch of properties we own in Investor Club. Check it out. You don't have to be an Investor Club. You don't have to be an accredited investor to come to this event. Wealthformulaevents.com is where it's at. I don't even know if there is any seats left. If there isn't, if it's sold out and you really, really want to come, shoot me an email, wealthformulaevents.com. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.